What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is January 1st of 2024. Well, folks, I hope you all are having a fantastic day wherever you are, and boy, does it feel weird to say January 1st of 2024. I hope you guys are having a great day wherever you are and a happy start to the new year. We've got three big topics we're going to be diving into today. Not only are we going to be talking about an updated take on Bitcoin's price as we're continuing to see stagnation in the trend and our indicator maintaining red over the past week, but we're also going to be talking about some of the key altcoin setups that we're looking at that could print big time if altcoins do start to find some support in the coming days and weeks. And last but not least, we're also going to be spending some time to talk about one of the new macro charts that we're keeping an eye on that could showcase the health of equity markets and whether or not we are overextended and due for a major pullback. We got a lot to unpack here in today's video, so if you guys happen to enjoy it, consider dropping a like. It's one of the greatest ways you can support the channel, and let's go ahead and kick things off. So I want to start here by talking a little bit about what's going on here with Bitcoin's price. I want to run through the basics here, and that is that we've got a few things we're watching for. We've got our key momentum indicator, which again we grant access to for anyone who joins the Dash report, and outside of that as well, we've also got the 21-day EMA as well as the 21-day SMA, the green and yellow lines here, right? So generally speaking, we're looking at these two things at the daily time frame to determine whether or not Bitcoin is still maintaining this strong trend that it's been in since back in October. As many of you know, once we came up into this range in October, we knew it was clear that there'd probably be some continuation from here as we had this 6-month consolidation range from back around March of 2023 towards around September. And with that breakout, we've continued to climb up towards around 44.5K. However, since back in early December, for nearly a month now, we've been stagnating sideways here. And that's left our momentum indicator not only flipping red, but us struggling now, not only to hold above the 21-day, which basically Bitcoin did the entire time, but we are not able to get above there over the last 4 days. That's not a good sign to see. Especially, not only are we not seeing buyers coming in at the 21-day, but now it's starting to act as resistance. Prior support acting as resistance is the first telltale sign that things may be ready for a cool down. Bitcoin might need to pull back in price. Doesn't mean that I'm saying that, again, it's going to new lows or yada yada, whatever. I'm just saying here that at the end of the day, this looks like it needs to cool down probably to one of its moving averages at a minimum here. I'm talking about things like the 100-day pocket or the 200-day pocket, which are ascending over time into this pullback that may play out. So that's the key point here that I want to indicate. Now that's the basics around Bitcoin, but as you all know, irrespective of what Bitcoin does here over the next few weeks and months, we got to see what happens coming up on January 10th. That's going to be the big news with the ETF announcement that many people are anticipating. A lot of the market is already priced in, is going to get approved, and it's going to be a big deal. We'll have to see how that plays out. But I want to focus in again on what's going on in altcoin markets. Whereas Bitcoin is struggling at its 21-day moving average and is now treating as resistance in the short term, that may be subject to change. Altcoins are holding strong right now. While yes, they've pulled back here by about, I would say roughly about 30 or 25, $30 billion over the last couple of days. For total 3, that's not much. It's still well above its 21-day EMA. The momentum indicator, outside of a slight red flip here back in late November, has held blue the entire time. So it's still remaining strong. The trend is there, and we cleared through the long-term accumulation range here within the altcoin channel. Now that's not to say we're going to new all-time highs or anything, but again, it at least sends signals here that the market right now remains confident. We can't fight that trend. And altcoins are where we can really make some sizable returns. If we just get 1, 2, or even 3 trades right within a year, we can walk out big time with some solid profits. And we can step back, wait in cash, and wait for a prime pullback and more opportunities to arise. Now, I do have feelings, as I mentioned here on the past few videos. While I'm not trying to get ahead of the trend or fight the trend, I think it is important to understand, guys, that altcoins, many of the plays that have helped to carry total 3, which excludes Bitcoin and Ethereum when it comes to its market cap or total value, we rallied from around 316 billion up here towards around a peak of around 532.5 billion. So don't be surprised if at the 21-day, we not only don't hold, but we get a solid breakdown towards some of these more sustainable moving averages, like again, the 100-day EMA pocket, or even potentially having the 200-day, which is not that far behind. These are going to start to pick up the pace here into a pullback, potentially going into January. We're going to have to see again how the ETF plays out, but for now, the trend is strong. The big thing I want to focus on is what plays we're watching for here. We're watching a couple key plays in the market, from meme coins to layer infrastructure for the Bitcoin network or Bitcoin related infrastructure. As we've talked about, those are the two main themes here of new emerging plays. And unlike the narrative of Solana and, for example, Avalanche and all these alternative L1s, which we will talk about as we go through the conversation, I think these ones have the markets of scale. Now, I want to spend some time to talk about that before we talk about some of the plays we have. You guys can probably see Bonk is one of our plays that we are watching here. I'm not saying go all in or anything like that, but I think that there could be a very favorable risk-reward setup on some of these plays that have already done quite well on a nice solid correction. Let's talk, though, first about markets of scale. Why is markets of scale important when we're looking at trades or investments? Markets of scale generally has to do with the understanding of how much something is valued at. Now, I think as much as the next guy, there's no fundamental way on how you can value meme coins or even some of the Bitcoin related infrastructure plays like ordinals, or even a network like Stacks, which is much more fundamental, sound, and is actually trying to build something valuable. There's no official structure on how you value these things. But there is one principle that is very easy to understand, which is that a play or a coin or token, whatever it might be, that is worth $1 billion is going to have a much easier time doubling to $2 billion versus an asset that is worth 10, 20, or $30 billion going to 20, 60, or, wow, sorry, I might be doing my math wrong there. 20, 40, or $60 billion in market capitalization. Don't get me doing too much math the first day of the new year. Don't worry, I didn't have any drinks or anything, guys. I'm just getting over a sickness at the moment. But you get my point here, that generally speaking, for multiples to play out, it's much easier for smaller plays versus larger plays. Bonk is a great example of this. While Solana, for example, did have a major move here of 625% here from September to December, definitely an outlier, definitely one of the market leaders, and definitely something to still define as noteworthy. Bonk in that period of time did something much bigger here. It made hundreds, if not thousands, tens of thousands of percentage of returns in the past few months in that same window of time, even a shorter window of time from back in October. So my point here, again, as I've always emphasized, is that we don't just have to get all juiced up when Bitcoin's making a move. We don't just have to get so excited when Solana's making a move. We need to be focused on isolated, key, handpicked narratives that are going to outpace the market big time. And whether we like it or not, meme coins are one of those plays, because for a play like Bonk, getting back to the topic of markets of scale, Bonk right now at its current market cap is less than $1 billion. Now, you may say that that's still, from a fundamental basis, way overvalued for what Bonk really is, a speculative meme coin. But Dogecoin, every given day, sits at a market cap well above multiple billions of dollars. In fact, I would think at this moment we could actually just take a look at it here. Doge's market cap, even after its pullback, it went to a total peak of around $100 billion at the heights, and it's still sitting here at around 12 billion. So my point here is that Bonk may still have a lot of room to run up, especially if we get it at a nice discount. So what are some of those ranges that we're looking for here, right? And a lot of the plays we're talking about are going to be plays that benefit from this market of scale concept. Well, what we're going to be looking for is, now that the trend has flipped red on the daily, the first time since back here in October, right? As we've seen in the past, these corrections can last for a while, and there's going to be a lot of dip chasers, again, who are going to try to buy in too early. What we want to look for is when price comes towards the next set of pockets of moving averages. It clearly broke through the 21-day, the standard moving average here, right? The exponential, excuse me, the yellow has broken through the green line here. All signs here, they're indicative of exhaustion, being overbought, and are essentially waiting for price to come down in towards one of these pockets. So we're going to be watching for bonk to come down into this range. And I'm not saying you need to wait exactly until it comes into these pockets. I'm just saying that this is where I would feel most comfortable building a sizable position on a trade. Because at that range, I'm not only working with a sizable discount of somewhere between 70 to 80%, but outside of that as well, I'm able to apply a nice hefty stop loss that's going to prevent me from easily getting my position knocked out, but give me the protection to make sure I don't end up losing everything if the trend goes south, and gives me the room to be able to have some really solid and confident take profit levels even before we get back to new all-time highs. That's a very important point to keep in mind here. If you can get an entry down in this range, you could be talking about hundreds of percentage points of gains without even getting back to new all-time highs. So this is again why you can continue trading market leaders, but you have to be solid and confident about making sure you preserve and protect your capital first, and make sure the market gives you those opportunities, especially when it's not coming up to the plate and providing support at more confident moving averages. Now you have a bit more wiggle room. You're not worrying so much about the trend and, basically buying in on FOMO. You are not waiting around for the 21 day because price is not holding there anymore. You're waiting for the 100 day or the 200 day, the next level of potential support for a broader and healthier correction to get rid of some of these parabolic gains and take in some of the distribution. Outside of that as well, I wanted to talk a little bit about ordinals, right? We've seen here with ordinals, again, it's still holding above the 21 day. The trend has been broadly blue for the most part. Most times when we get a red flip here in the daily here, that's usually the point when we're in the 21 day pocket and buyers come in. But I have to tell you guys here, while I like Ordi in this case, again, market cap, it gives it definitely room for market to scale. In this case, I think ordinals don't have I know this might sound a bit silly, but they don't have the virality of a meme coin. And also, getting access to Ordi is not as easy as bonk. Not only in the range of exchange listings, but also along with that as well, in the amount of dexes where you can access this, right? There's a lot of Solana dexes that are very easy to interact with, whether you like Solana or not. From a network security perspective, at the end of the day, Solana is definitely very easy to onboard onto. There's exchanges that have Sol as a pair. It's very easy to go out and purchase these meme coins. So my main point here is that I think Ordi, as we've talked about, might have a chance to get up towards $100, but I really wouldn't be chasing this one. I would be waiting for this to probably come back down at this point into the 100 day or 200 day pocket for a further move later on in Q1. Stacks is one of the few plays here. As I take a look here in the weekly, that considering it's the more fundamental play, even though it is the largest of the three that we're talking about by market cap terms, I think that this has the narrative to have a full, essentially token reversal here from its initial listing on Coinbase. I think that this could really be a free runner here that just breaks out as Bitcoin is the narrative here going into the next few months. The volume profile looks really good. And if you consider that like Solana, for example, which again, outside of people speculating on meme coins and a few very flimsy narratives around gaming, DeFi, I mean, guys, come on, like name 3 applications that you guys are really using on Solana. Outside of DEXs to speculate on meme coins, like anything that's transformative or new, any reason you'd have to use Solana on a daily basis. I can't think of any. I don't know anyone who can name any. And because of that, we need to look for plays that are equally as valuable from a programmable standpoint. Stacks meets those criteria. And outside of that as well, are related towards the central focal point of this move in crypto markets over the last year, which is Bitcoin. So if there is going to be a play here that I think really could just rally onwards here, Stacks is one of those plays. It's still one that is slept on by a lot of people. And I gotta be honest, I like plays that are making solid moves, and I don't sense that there's a big retail presence for it. So if you're looking for more one of those buy and hold plays, I think that Stacks is one of those. And it's one that has continued. While Bitcoin has pulled below its 21 day, Stacks gets bought up every time at the 21 day. And over the last few days, even bounced up here without coming down to retest it. So that's a good look here. Again, not to say that it can't break the 21 day and come down. If it does, maybe you hold back for a while. But for me, I like the longer term setup here. I think this one has been like a sleeping giant for a long time. And a lot of people are looking for that programmable layer on top of the Bitcoin network where you can use Bitcoin as the core asset, right? Even as gas, as currency. But outside of that as well, being able to essentially have that programmability for the most liquid network in the world. BTC's market cap, if we come down here, current prices is $835 billion. It's almost $1 trillion asset that is still relatively illiquid. There's not much you can do with it outside of, Bob sent 1 Bitcoin to Alice type transactions, just send and receive. I think we need to see more, and more beyond just ordinals. I'm talking about real DeFi applications where Bitcoin can be used as collateral, Bitcoin-backed stable coins. I think that there's going to be some really awesome opportunities for whoever really tackles this market first. But anyways, I wanted to close off on the altcoin topic, guys, which is, again, to focus on Bitcoin dominance here. We have seen a pretty big shift here in altcoin dominance. I'm interested to see how we react with the 200 week here. And also with our momentum indicator on the 2-week time frame, we've remained a blue flip since back here in December. A red flip on this could be indicative of a really big move in altcoins, irrespective of the fact that we are looking for that potential correction here. Maybe we hold up here for a couple weeks, as we saw back during January to March of 2021, where Bitcoin dominance really started to collapse into March and April. So it might take some time. Right, we still might get that healthy pullback in both Bitcoin and in altcoins, and then as Bitcoin starts to pick up, maybe post ETF or right before it here in early January, then altcoins can start to surge up as well. All right, last thing I want to talk about here, guys, is going into the macro conversation. Today, I want to share an interesting chart with you guys that I think showcases that we are getting, in the broader sense of things, into the later stage of the move we see in financial markets. While I do believe that there are some really great short-term opportunities, I do not believe we are in for a generational bull market over the next few years. And I want to spend some time to explain that. Today, I want to show you a chart that is a custom ratio that I've never seen anyone cover before. I bet there are probably, if you scour the internet, there's probably someone who's covered it. But this is a custom chart that I generated here that takes the S&P 500 and divides it by the VIX. Now, I want to spend some time to describe these. The S&P 500, or SPX, is one of the broad stock indices. The S&P 500 is the 500 largest companies that are publicly traded in the United States, divided by the volatility index, which is measuring the volatility spread on call and put options in the S&P 500. So why is it important to generate this ratio, and what valuable information could we potentially get from looking at this ratio and what it tells us about the health of financial markets? Well, let's go ahead and dive into it. There's two big things I want to spend some time to talk about here that I noticed as I look at the longer term trend on the logarithmic scale. I noticed that as we go throughout history here over, say, the last 30 plus years, we can see that there are periods of time where we come down into this corrective channel, right? We've seen this happen all the way back since 1993. We even had a dip down here towards March of 2020 during the lows of the COVID crash that we saw back then. And outside of that as well, we generally see an expansionary wave here where we set higher levels over time in regards towards this custom ratio where they have the S&P 500 divided by the VIX. Now, what's causing this move here, right? Well, the biggest reason this is playing out is because you have the volatility index, which essentially moves inversely to the S&P 500. So if volatility is going down, it usually means that equities are in a good period of time. They're moving up. They're not having many volatile dips or drops in price, and vice versa. The S&P 500 is starting to move lower, so the value of the S&P 500 is moving lower. The VIX is usually shooting up, and that's why you get these sharp moves here. It helps us to really spot exuberant periods of time, and also periods of time of exuberant, or in this case, detrimental amounts of fear in the market, right? So we want to be able to kind of use this as a sentiment gauge to know, hey, historically speaking, we understand that this is going to kind of expand over time, but how far away are we from reality? Are things getting a bit too manic in the market? Well, we can see, generally speaking, that as we take a look back here from the first significant kind of point here back in 1993, right, an alignment. If you just draw a general trend line here, you don't have to get it perfect, but generally speaking, if you want to spot like within a couple weeks, few months, when you're getting towards a market top, whether that be, for example, shorter term corrections like in December 2017 before the short term correction about 20-25% in 2018, Whether, for example, you want to try to spot recessionary bear markets like here in February and March of 2017 that preceded the 2008 recession, the dot-com bubble, and many volatile swings in markets within those given periods of time before those bigger recessions and bigger crashes come. Well, this line is your friend here. And I have to say, we've got a little bit of room left to run here, but not too much. Right? And that's why, again, I like to be generous here with like the trend line. Right? I don't want to, just drag it down and meet to my narrative and say, oh, we're guaranteed to be at a point where market prices need to pull back. But again, I think that this is a very valuable gauge here that showcases that, hey, if you're buying into this environment, you're not buying in at a really big discount. Right? You're buying in at a very hefty premium. And this is not the only chart that tells us this here. Right? As we'll talk about later on, there are some other indicative signs, like when you take global equities and you divide it by global liquidity. We'll also talk again about some of the recessionary signs we want to look for, right? A lot of things that unfortunately get lost because people are believing in the soft landing theory. Another thing you can also indicate from this chart is you'll notice that during upcoming recessionary periods, there's a typical repeated pattern here with the S&P 500 VIX ratio. You can find that there are these general periods of time, ascending over time. You have slightly higher levels here for the S&P 500 divided by the VIX. But generally, you've got these kind of resistance ranges here. And then eventually, there's a blow off top, kind of above that line of resistance. We collapse back down through there. And that preceded, again, a 2-year bear market, otherwise known as the dot-com bubble collapse. We can see here as well, 2005 to 2006, similar resistance range, right? We break up, deviate above there, collapse through, start acting as resistance at that range. That's your cue that the market's going to move down for the next few years. And what do you know here? We're seeing a similar pattern over a much longer period of time here. 2018, 2021, right? Both of those prior to market tops there, right? Or significant ranges where price saw significant correction. We've deviated slightly above there. We're getting up close to that line of potential resistance. And it's likely that eventually, here sometime in 2024, we roll over and start to see a hefty correction. I'm not saying it needs to be as fast and furious as March 2020, and I'm not saying it's going to look exactly like these two corrections in the past, but all of these recessionary bear markets over the last 30 years saw a correction back below, somewhere below 37 or 38 here on the S&P 500 and VIX ratio. And boy, are we extended away from that. So again, you guys can see here in the video today, this is again the important nuance here about myself as a trader and anyone who's, I think, traded for a decade plus. You can make some really great short-term opportunities when you know momentum is there, but don't get caught drinking in the punch bowl. Don't get thinking that this is the new norm, that we're going to new all-time highs, that AI or whatever narrative has got you excited is just going to change the world overnight, and that the soft landing is here and everything's going to be fine. It doesn't matter if inflation is still sticky at 3 or 4%, maybe even worse in other economies. Let's brush it off. The punch bowl's full because, the Biden administration is using the Fed's tools or whatever the narrative might be to keep things going good for a while until it's an election year, right? We got to just go along with the party. Sure, maybe that's the narrative for now. We have fun with it while it lasts, but don't get caught up continuing to rationalize why markets need to move up. History tells us that can eat your profits alive. The market gives and the market takes. It's the biggest lesson I've learned. You overtraded the market, you get overly confident, the market will take right back what it gave you and sometimes take even more with it. That's what the smart money relies on, that you're gonna get caught up in the euphoria. And you gotta bring back this chart here, guys, since back in 2009, right? In a world that is absolutely now driven by liquidity and QE. It's been that way for a long time, as long as I've been trading, and I think as long as most of us here have been trading. And I gotta tell you guys, we have been in overbought territory here since back in the summer. And I understand there's excitement around the AI narrative. That's definitely gonna be transformative to an extent. But I have to tell you, I don't know if that's gonna be enough to continue carrying forward equities here when we are in the same extended range, the most overbought we've seen in 15 years for equities against global liquidity. That's not a bet that I'm willing to build massive sizable positions in, especially not passively in the S&P 500 and not in the typical stocks that did well over the last decade. You know, the big technology plays like Apple, Microsoft, which mind you are each respectively $3 trillion companies. Going to be real difficult to get those to $6 trillion market caps in order to make a 100% return, even over a 3 to 5 year period. I don't see that happening, right? And the same goes for the FANG stocks. How are they going to continue increasing earnings? I think many of them have capped themselves out. One last thing I want to talk about again is a misconception that I've seen some people talking about, and that's oil. Now, a lot of people see oil's price decline as a really great sign here that, hey, Nick, the fight against inflation, the Fed has won, right? And to be fair, like inflation is still sticky at like 3.2, 3.5% in the United States. I have to check the official CPI figure later, but generally speaking, inflation is still well above the 2% target. The Fed needs to get it below 2% and keep it there for a long time in order to really keep inflation down. But I think the Fed may very well be on their way there with the rate hikes that they placed in. The only problem is that people think that this means, oh, well, oil prices are down, inflation's down, soft landing, party time, everything's all good, and we're going into a new bull market, new all-time highs, and we're just going to keep surging higher and higher and higher. Wouldn't be so certain about that, because when oil collapses, this is your indicative sign, especially when it goes below the 200 week. That is your sign of a recession. We saw that here in 2008. We can see here as well during, for example, 2020. You can see it here in 2018 as well. A lot of periods of time where oil corrections were not met with market euphoria, but market corrections. Here in the dot-com bubble, 36, down here towards 18. Hefty corrections, right? So oil contracting is not a sign of good times to come, right? Maybe that does provide a foundation later on towards bolstering economic activity. But more than anything, this is a key sign here that things are about to slow down. Right? There's a reason oil went up during the good times in equities when money was cheap and easy, and now as we're tightening monetary supply, right? This is an indicative sign that things are likely correcting to some degree. It doesn't mean something has to break in the economy like in 2006, 2008, the housing market. It doesn't mean that technology companies are just going to be wiped off the face of the earth like during the dot-com bubble. It could just mean that we go into an earnings recession, a mild one. And that may mean that we don't get a whopping 50% correction in asset prices, but we may need a 25, 30% cool down, a little bit of a bring back to earth moment for asset prices. And that will probably not be beneficial for Bitcoin or crypto assets as well. So we need to be ready to stomach that. We got to be positioned well. We got to make some great returns while the momentum's here, if it still remains here for the next few weeks. And we step back with our cash and we wait. It's as simple as that. So if you guys want to continue keeping up not only here with the content we create on the YouTube channel, we create 3 videos here every week here for you guys where we dive into videos Monday, Wednesday, and Friday. I not only ask if you like the channel and you haven't already, consider subscribing and join the family. Consider dropping a like if you enjoyed this video. But outside of that as well, you guys can also check out the Dash Report. We just are planning to drop out our new edition either later today or later tomorrow. You guys can check it out here if you want to learn a little bit more. I'll have a link down below in the description where you guys can dive into it. But the Dash Report is our newsletter here on the channel where we're focused on all kinds of different financial markets. We're focused on crypto, stocks, commodities, and Forex. It's a 20-page plus newsletter where we encompass all of our views on these different markets. We have our mid-month webinar we do where we answer questions from those of you in the community. We sometimes send exclusive market updates. We'll send out trade alerts. You guys get access towards our portfolio allocation that we mentioned within the Dash Report newsletter. All kinds of really good stuff, and the Dash Report discussion group where you can chat with all kinds of quality members from our community, over 1,000+ members in the Dash Report community. But anyways, that's it for today's video, guys. I hope you all enjoyed this video. If you again happen to enjoy it, consider dropping a like, and I'll see you guys on Wednesday at 6 a.m. Eastern Standard Time for the next video. Take care, everyone, and I'll see you all soon.